All right, today we're cracking open a really interesting business case file. The company at the center of it all is the Indian fintech giant Groww. The investigator? None other than the investment bank, JP Morgan. And the central mystery? Well, it looks like the market might be misjudging this company by a few $billion. So let's get into it and see what the evidence really shows. So here's the heart of the matter, straight from the analyst report. JP Morgan took a hard look at Groww and saw this powerful all-in-one financial machine. But then they looked at its valuation, and things just didn't add up. Why would the market be sleeping on a company that seems to have the whole package? That's the big question we're going to dig into. Okay, so let's call this Chapter 1 the Fintech puzzle. You've got this company that's growing like crazy in a market that's absolutely booming, but for some reason, its valuation seems disconnected from that reality. Our mission here is to follow the trail JP Morgan laid out and figure out what everyone else might be missing. And this chart, wow, this really lays the problem out in black and white. It shows the projected price to earnings multiple, which is basically how much investors are willing to pay for $1 of a company's future profits. You see Groww there at a multiple of 27. Now look at its peers in the Indian internet space. They're at 51. Even the more traditional market companies are higher at 32. I mean, that's not just a tiny gap. That is a massive difference. So what on earth is going on?
All right, time to put on our detective hats and get into the investigation. To solve this puzzle, the analysts at JP Morgan started hunting for clues. And the very first place they looked? Growth. But we're not talking about just any kind of growth. We're talking about a very specific, very powerful type of growth that tells a story.
So here's our first piece of evidence. In just about a year, Grow's piece of the retail investing pie absolutely skyrocketed, going from 18% all the way up to 29%. That's a huge jump. It shows that while their competitors were kind of just holding steady, Groww was out there absolutely crushing it, pulling in a huge chunk of the market.
And check this out. This is maybe even more important. How did they get all those new customers? Well, over 80% of them just showed up. They came organically. This wasn't because of some crazy expensive Super Bowl ad. People are actively seeking out Groww. You know what that means? Their cost to get a new customer is incredibly low. That's a secret weapon for long-term profitability.
And here's a clue that's all about the future. A massive 3/4 of Grow's users are young. Now, why is it such a big deal? Think about it. These folks are at the very start of their careers. As they earn more and save more over the next 10, 20, 30 years, they're probably going to invest more, right? And they've already started their journey with Groww. That is a massive long-term growth engine just waiting to happen.
So the growth story is rock solid. But is it a sustainable business? That leads us to the next part of our investigation, digging into Grow's profit engine, and, more importantly, seeing how it's being transformed for the future.
Okay, so this is what Groww used to look like just a few years ago. You can see the problem right away. Almost 3/4 of their money came from derivatives trading. Now, that's a high-volume business for sure, but it's also super volatile and risky. Relying that heavily on one thing is a huge gamble, and investors tend to get nervous about that. But now, look at the forecast for 2028. It's a completely different story. Derivatives are expected to drop to about half the business. And you see these other big, beefy revenue streams popping up from regular stockbroking, wealth management, and even lending. This is a much healthier, more balanced business. It's way more resilient. So here's the bottom line. The market might still be looking at Groww and seeing a simple, risky trading up. But the reality is that it's turning into something much bigger, a full-blown financial ecosystem. It's becoming a one-stop shop for all your money needs.
And this transformation, it has an absolutely incredible effect on profits. Because Groww is built on a tech platform, it costs them very little to add more customers. So as revenues shoot up, their costs barely budge. And what does that mean? Profits go through the roof. Their margins are projected to almost double, from 36% to a stunning 67%.
Okay, let's recap the evidence. We've got explosive organic growth, a super young customer base, a smart shift away from risk, and profits that are set to explode. So now it's time for the big reveal. How did JP Morgan put all these pieces together to come up with their final verdict? Well, they didn't just pull a number out of a hat. They had a very clear method. They looked at a mix of similar Indian internet companies and global brokers to create a fair benchmark. From there, they used a special metric that balances a company's valuation against its growth rate, and then they applied that to what they think Groww is going to earn in the future. And here it is, the final verdict.
a rating of overweight, which is basically Wall Street speak for, hey, you should probably buy this, and a price target of 210 rupees. When they wrote this report, that suggested the stock could go up by about 30%. The conclusion from this whole investigation is that, based on the evidence, the market just might have this one wrong.
But hold on. No good investigation is complete without looking at the other side of the coin. A smart analysis always points out the risks. So before we close this case file, we've got to take a quick look at the fine print. There are really three big things to watch out for. First, regulators could step in and change the rules, especially for derivatives, which could slow things down. Second, the government could raise taxes on trading, which would make it more expensive for everyone. And third, the most obvious one, if the Indian stock market goes into a long slump, well, that's going to hurt any company that makes money from people trading stocks. And that leaves us with this final central question. On one side, you have JP Morgan's detailed case, pointing to what looks like a hidden gem, a powerful, undervalued growth company. But on the other side, you have the market, which seems to be more focused on the potential risks. We've laid out the evidence. The big question is, which side of the story do you think is right?